Imagine building a multi-million dollar luxury fortress. You install the best security cameras, the strongest vault doors, and state-of-the-art alarms to protect your wealth. You check the perimeter every single day, proud of the empire you are building. But in your absolute obsession with front door security, you leave the back door wide open. Now you might think this is an extreme example. But what if I told you this is exactly how most people manage their financial life today? Millions of highly intelligent investors track their mutual funds daily, negotiate real estate deals aggressively, and monitor the stock market hour by hour. But they remain completely blind to the open back door. A single medical emergency, a sudden loss of income, or one unexpected liability, and everything they build start collapsing from the inside. Today we are not talking about how to make money. We are talking about how to protect it when life goes wrong. Because this is the defensive playbook of the top 1%. And this is where most investors unknowingly fail. There is a dangerous illusion in personal finance. People confuse saving and investing with risk management. You might have a strong equity portfolio, prime real estate, and solid fixed deposit. But if your foundation is fragile, your wealth is simply a heavy structure waiting to collapse. Here is the real problem. Investors assume that accumulating assets automatically protects them. It does not. Building assets without a risk framework is not investing. It is gambling with your family's future. To understand this better, look at how financial planning works globally. In developed markets like the United States and the United Kingdom, wealth creation is always phase 2. Phase 1 is strict, uncompromised risk management. They build the most before they build the cost. But in emerging markets, most investors reverse the order. They rush to invest their first paycheck into high return assets, while leaving their entire financial life exposed. They cause a 12% return while taking a 100% risk. And this is where the real danger begins. Let us bring this closer to your life. Imagine your primary income stops tomorrow at 9 am. By 10 am, the world has not stopped. Your home EMI is still due. Your car loan continues. Your children's school fees are still pending. Now here is the brutal math. It takes 10 years of disciplined investing to build a strong corpus, but it takes less than 10 days for a severe medical emergency or financial shock to wipe it out completely. In the short term, unmanaged risk creates panic. In the long term, it destroys stability. Families are forced to liquidate assets, often at the worst possible time and at a heavy loss. And this is how wealth actually gets destroyed. So the real question is, how do you prevent this? What is risk management really? In simple terms, risk is the probability of financial loss, and risk management is the system you build to ensure that when that loss happens, your financial life does not collapse. It is your personal shock absorber. It protects your family and allows your investment to continue growing even when life becomes unpredictable. Now, how do you actually manage risk? You follow a simple global 4-step framework. Step 1. Identify. You cannot protect yourself from something you cannot see. The biggest mistake people make is misidentifying their risk. Ask someone their biggest risk and they will say, stock market crash. But market crashes are temporary. A long hospitalization or loss of income is not temporary. That is structural damage. You must identify your real financial threats before they happen. Step 2. Prioritize. Not all risks are equal. A scratched car bumper is inconvenient, but it will not destroy your finances. But a permanent disability or a major liability can impact your entire lifetime income. So the rule is simple: protect against financial ruin first and inconvenience later. Step 3: Protect. This is where strategy becomes action. There are four ways to manage risk. You can avoid risk, you can reduce risk, you can retain small risk, or you can transfer large risk. For example, you avoid risk by staying away from the dangerous decisions. You reduce risk by maintaining health and discipline. You retain small risk through emergency fund. But here is the critical question: what about risks that are too large to handle? This is where everything changes. For catastrophic risk, you do not manage them alone. You transfer them. You pay a small predictable cost today so that a massive predictable loss tomorrow is handled by a larger financial system. And this is exactly where tools like health insurance and term insurance come into play, not as investments but as protection mechanism. Step 4: Review. And this is where most people fail because they treat financial planning as one-time activity. But life changes, and so do your risk. At 25, your risks are minimal. At 35, you have responsibilities. At 45, your financial exposure is much higher, which means your protection must evolve. A strong financial plan is not static, it is continuously updated. Now, this brings us to an important point. When you speak to a financial professional, they should not begin by asking how much can you invest, because that is not advisory, that is selling. A true professional works differently. A responsible advisor acts as your risk manager. They help you identifying your risk, prioritize them, and build protection before recommending any product. And this is exactly what you should expect. So here is the takeaway. Do not build wealth on a weak foundation, because wealth is not destroyed by market crashes, it is destroyed by unmanaged risk. Start understanding your risk before you plan your investments. If you want to go deeper, we have created a detailed guide for you. You can explore the complete insurance and risk management guide on our website Jeevan Bima Bazaar. Protect your foundation so your wealth can grow without fear. Thank you so much.